In the early months of 2025, the global economic landscape was jolted by a series of aggressive tariff implementations by the United States, marking the onset of a turbulent period for international trade and investment. President Donald Trump, reinstated for a second term, initiated these measures with the intent of rectifying perceived trade imbalances and safeguarding American industries. However, the ramifications of these policies rippled through various sectors, sowing seeds of uncertainty among investors and business leaders alike. On February 1, 2025, President Trump signed executive orders imposing a 25% tariff on all imports from Mexico and Canada, excluding Canadian oil and energy products, which were subjected to a 10% tariff. These tariffs were scheduled to take effect on February 4, 2025. The administration justified these actions by citing concerns over migration and fentanyl trafficking, aiming to pressure neighboring countries into addressing these issues more aggressively. In parallel, a 10% tariff was levied on all Chinese imports, effective the same day. This move was part of a broader strategy to reduce the U.S. trade deficit with China and address long-standing issues related to intellectual property rights and market access. The targeted goods encompassed a wide array of products, including electronics, textiles, and machinery. The immediate aftermath of these announcements was a surge in market volatility. Investors grappled with the potential implications of escalating trade tensions, leading to significant fluctuations in stock prices. The S&P 500, a benchmark for U.S. equities, experienced a sharp decline of over 10% within 2 days, reflecting the market's apprehension. BlackRock CEO Larry Fink noted that most CEOs he engaged with believed the U.S. was on the brink of a recession, attributing this sentiment to the newly imposed tariffs. The automotive industry, heavily reliant on cross-border supply chains, found itself at the epicenter of the turmoil. Major manufacturers like General Motors and Ford faced increased production costs due to the tariffs on steel and aluminum imports from Canada and Mexico. These additional expenses threatened to erode profit margins and necessitated considerations of price hikes for consumers. Furthermore, the disruption of established supply chains posed operational challenges, compelling companies to reevaluate their manufacturing and sourcing strategies. In response to the U.S. tariffs, Canada and Mexico swiftly announced retaliatory measures. Canada imposed 25% tariffs on 30 billion Canadian dollars worth of U.S. goods, targeting sectors such as steel, aluminum, and various consumer products. Mexico signaled its intent to enact similar countermeasures focusing on agricultural products and industrial goods. These retaliatory actions further heightened the uncertainty as businesses now had to navigate a complex web of tariffs affecting both imports and exports. The technology sector was not immune to the upheaval. Companies like Apple, which relied heavily on Chinese manufacturing and Taiwanese semiconductor suppliers, faced increased production costs due to the tariffs on Chinese goods. This scenario posed a dilemma: absorb the additional costs, thereby reducing profit margins, or pass them on to consumers, potentially dampening demand. The semiconductor industry, integral to a myriad of electronic devices, also faced disruptions. Firms such as Nvidia and AMD, dependent on Taiwanese foundries for chip fabrication, encountered increased costs and supply chain bottlenecks. Retailers, particularly those in the apparel and consumer electronics sectors, braced for the impact of higher import costs. With over 40% of U.S. apparel and footwear imports originating from Asia, the 10% tariff on Chinese goods threatened to inflate prices for consumers. Major retailers like Walmart and Target faced the challenge of balancing the need to maintain competitive pricing with the imperative to protect profit margins. This delicate balancing act was further complicated by the potential for reduced consumer spending in response to higher prices. The energy sector also felt the tremors of the tariff impositions. The 25% tariff on steel imports affected the construction of pipelines and drilling equipment, potentially hindering domestic energy projects. Moreover, the tariffs on Chinese imports included components essential for renewable energy technologies, such as solar panels and wind turbines, posing challenges for the burgeoning green energy industry. Amidst this landscape of escalating trade barriers and retaliatory measures, investors found themselves in uncharted territory. The traditional paradigms of global trade were being upended, and the path forward was fraught with uncertainty. Companies across sectors were compelled to reassess their supply chains, cost structures, and market strategies to navigate the evolving terrain. The specter of a full-fledged trade war loomed large, with the potential to reshape the global economic order and redefine the principles of international commerce. As the dust settled on this initial salvo of tariff implementations, it became evident that the ramifications would be far-reaching and multifaceted. The ensuing months would demand agility, foresight, and resilience from businesses and investors alike as they endeavored to chart a course through the stormy seas of trade uncertainty. As the new tariffs took hold, it didn't take long for the aftershocks to reverberate across the globe. Markets were already jittery, but now investors were trying to read between the lines of government briefings, comb through earnings reports, and listen closely to CEOs hinting at future restructuring. For Americans, especially those with retirement accounts tied up in mutual funds or 401(k)s, every ripple felt like a wave. On Wall Street, the Dow Jones continued to seesaw. Analysts at Goldman Sachs and J.P. Morgan Chase downgraded their GDP forecasts for the second and third quarters of 2025, pointing directly to the tariffs as the root cause. Industrial giants such as Caterpillar and Deere & Company, both with global exposure and heavily reliant on international components, saw their stock prices tumble. Investors, once confident in the rebound of American manufacturing, now faced a difficult reality. Protectionism may help certain domestic industries, but it also stifled growth and created bottlenecks. Meanwhile, in the heartland of America, farmers felt the sting almost immediately. Soybeans, corn, and pork were top U.S. exports, especially to Mexico and China. With both countries responding in kind, tariffs on American agricultural products soared. China, for instance, halted large-scale purchases of American soybeans, opting instead to turn to Brazil and Argentina. This was a particularly harsh blow for Midwestern states like Iowa, Illinois, and Nebraska, where agriculture is the backbone of the economy. John Wilcox, a fifth-generation soybean farmer from Indiana, shared on a local news segment, "We were promised wins, but right now, we're just trying not to go under." To keep his farm afloat, John had to lay off 2 seasonal workers, delay the purchase of a new combine, and restructure debt with his bank. He wasn't alone. Across rural America, tractor dealerships reported massive inventory surpluses, banks flagged agricultural loans as higher risk, and food producers scrambled to cut costs without sacrificing quality. In cities, the impact was less visible but still pronounced. Logistics companies like FedEx and UPS, already strained by supply chain issues left over from the pandemic, now had to reroute shipments, pay new customs fees, and face delays at ports where newly enforced tariff inspections clogged the system. Small businesses, those who imported packaging materials, raw ingredients, or even retail items from abroad, began to feel boxed in. Sarah Cortez, who ran a boutique organic skincare brand out of Austin, Texas, relied on glass bottles from China and essential oils from India. The costs shot up by 20% in 2 months, she told her followers in a YouTube livestream. "I'm raising my prices slightly, but I know I'll lose some customers. What else can I do?" These tariffs are crushing small entrepreneurs. On the international front, global leaders criticized the U.S. for what they called a zero-sum approach to trade. The European Union warned it would also retaliate if targeted. At the World Economic Forum in Davos, the general sentiment was clear: this era of American protectionism was creating more harm than good in the interconnected web of global commerce. But not everyone saw gloom. Some investors turned to domestic manufacturing ETFs, betting on a U.S. industrial renaissance. Companies like U.S. Steel and Nucor reported stronger-than-expected earnings in Q1 2025, attributing the growth to increased domestic demand and reduced competition from abroad. Defense contractors and aerospace firms, too, saw a small bump as military procurement favored American-made components. Still, the big-picture view remained cloudy. The IMF issued a global warning, stating that prolonged trade tensions could shave 1.5% off global GDP growth in 2025. They cautioned that a trade war is easy to start but much harder to end, especially when political pride and campaign promises are involved. Investors around the world began to shift their strategies. Hedge funds and institutional players turned to safe haven assets, gold prices rose steadily, the dollar appreciated as foreign capital sought stability, and bond yields began to dip as demand for U.S. treasuries climbed. In this uncertain environment, one group benefited more than anyone else: geopolitical analysts and risk consultants. Companies scrambled to understand the cascading effects of tariffs, not just on pricing, but on workforce, supply chains, and even future investment locations. A Boston-based risk consultancy reported that client requests had tripled since February. Back home, the average American consumer started to feel the change at checkout lines. Electronics became pricier. Basic groceries saw modest hikes. And economists warned that if retaliatory tariffs continued, inflation could rise just as the Fed prepared to ease interest rates. The first domino had fallen. The question wasn't whether the tariffs would reshape the American economy, it was how deep the changes would go and who would come out ahead once the dust settled. By mid-2025, American investors found themselves divided into two camps, those who panicked and those who pivoted. On CNBC, Bloomberg, and dozens of finance YouTube channels, voices clashed over what to do next. Should investors pull their money out of international funds and go all in on domestic stocks? Should they move toward hard assets like real estate, gold, or even crypto? Was now the time to hoard cash or double down on contrarian bets? No one had the perfect answer, but a few patterns began to emerge. First, the clear winners. Domestic-focused companies with low exposure to foreign markets started to outperform. These were businesses that sourced locally, manufactured in the U.S., and sold primarily to American consumers. Think regional banks, mid-cap utilities, construction firms, and local food producers. Take, for example, Clearwater Timber, a lumber company based in Montana. Once a sleepy stock with little movement, it saw a 40% gain in Q2. As tariffs drove up the cost of imported wood, domestic suppliers like Clearwater saw a surge in orders from home builders and furniture manufacturers. Another big winner, cybersecurity firms. With rising geopolitical tensions and digital infrastructure becoming more vulnerable to international sabotage or espionage, American companies boosted spending on data security. CrowdStrike, Palo Alto Networks, and SentinelOne all hit record highs, with hedge funds gobbling up shares. Meanwhile, tech giants were getting squeezed. Apple faced supply chain disruptions due to its manufacturing plants in China and Vietnam. Tariffs on components pushed up the price of iPhones and Macs, leading to a consumer slowdown. Microsoft had to renegotiate server hardware contracts. Amazon, too, had headaches. Rising import costs on everything from electronics to kitchenware forced it to hike prices for Prime members. Consumers grumbled. Investors groaned. And yet, in all this, opportunity glimmered for the bold. Darren Levine, a 35-year-old retail investor from Denver, made headlines when his $80,000 investment in an obscure Midwestern steel fabrication firm ballooned to $400,000 in 6 months. He'd posted his analysis on Reddit's r/investing forum. This company only sources American steel, services defense contracts, and is expanding. With these tariffs? It's a no-brainer. Darren became a symbol of a new class of investors, agile, research-driven, and highly online. He didn't listen to traditional financial advisors. He watched factory drone videos on YouTube, tracked shipping manifests, and read trade law. People like Darren were reshaping how investment stories were told and followed. But for every Darren, there were dozens like Rita Holmes, a 62-year-old retiree in Florida. Rita had placed much of her savings into a high-performing international mutual fund. She'd enjoyed double-digit growth for years. Now, her portfolio was down 17% in 5 months. Her retirement advisor offered her little comfort. These things happen. It's just market cycles. But Rita wasn't buying it. This isn't a cycle. This is policy. This is political. And my retirement shouldn't be a casualty of someone's trade war, she told NPR in a bitter interview. Foreign investment in the U.S. also began to dry up. Uncertain about the long-term implications of the tariffs and ongoing political rhetoric, several European and Asian firms shelved expansion plans. Auto companies from Germany delayed opening plants in the southern U.S. Battery manufacturers from South Korea postponed billion-dollar deals. Even some Canadian tech firms redirected their focus toward friendlier jurisdictions. This had a trickle-down effect on real estate and employment. Cities like Nashville, Austin, and Columbus, once booming with international startup energy, saw a slight but noticeable dip in commercial real estate occupancy. And yet, while big money hesitated, some venture capitalists leaned in. Peter Thorne, a VC with Patriot Capital Partners, appeared on a podcast and summarized his position. Look, these tariffs are not going away tomorrow. But guess what? They've created a new economic sandbox. Logistics tech, American sourcing startups, AI-driven procurement software, these are the next unicorns. We're not running from the fire. We're running into it. Patriot Capital raised a $300 million fund focused solely on American-made ventures. Their bet? That in this new tariff-fueled economy made in the USA wasn't just a slogan, it was an investment thesis. Meanwhile, the government tried to steady the ship. The Commerce Department offered subsidies to industries hurt by retaliation. Congress debated a stimulus bill targeting small businesses struggling under the weight of increased import costs. There were even whispers of a digital infrastructure package aimed at boosting domestic cloud computing capacity, an indirect shot at global tech dependency. The average investor, however, felt more confused than confident. One week, markets surged on rumors of a trade deal. The next, they sank as talks collapsed. Media headlines shouted about the next recession and the new normal. In homes across America, people asked the same question. Where should I put my money now? The truth was, no one had a crystal ball. But as the dust settled, one thing became clear: this wasn't just about tariffs. It was about how the world was reorganizing itself. About how supply chains, geopolitics, investment psychology, and national identity were all blending into a new economic reality. And those who could read that story correctly, not just react, but understand, stood the best chance of coming out ahead. By late summer 2025, what began as a series of sharp policy moves had evolved into a full-blown ideological war, both on Capitol Hill and in American households. What started with trade tariffs was now about the soul of economic nationalism versus the efficiencies of globalization. The investment world, still staggering under the weight of volatility, now had to decipher the battle lines in Washington, D.C. The Senate was split down the middle. On one side were the economic patriots led by Senator Blake Radford of Ohio, a staunch advocate for hardline tariffs and reshoring manufacturing jobs. On the other side were the global realists, a coalition of centrists and market liberals who argued that isolation was costing American families dearly and turning investors away. I don't care what Wall Street says, Radford thundered during a televised debate. The American worker comes first. If that means a few short-term hits in the market, so be it. We're investing in sovereignty. Opposing him, Senator Lisa Meyer from Oregon countered, this isn't just about patriotism, it's about practicality. When the price of bread, batteries, and broadband all go up, don't expect voters to cheer. This isn't sovereignty. It's self-inflicted injury. The rhetoric played well on cable news, but investors weren't interested in speeches, they were watching numbers. And the numbers were confusing. Inflation had risen again, 3.9% year-over-year, driven largely by elevated input costs across key industries. The Fed, which had signaled potential rate cuts earlier in the year, hit pause, fearful of adding more fuel to the fire. Wall Street reacted with wild swings. Some sectors soared, especially domestic energy and agriculture, while others, like consumer tech and retail, struggled to maintain margins. Yet amidst the chaos, something surprising happened. A new breed of financial innovation began to take shape. Several major asset management firms launched thematic ETFs, exchange-traded funds, that focused entirely on tariff-resilient sectors. These funds tracked industries like domestic semiconductors, recycled materials, rail logistics, and even rare earth mineral refining within U.S. borders. BlackRock's America First Supply Chain Fund hit $2 billion in AUM within 6 weeks of launch. Vanguard wasn't far behind. Retail investors gobbled up these products, not out of blind nationalism, but because they aligned with emerging policy directions. If the government was reshaping the economy, then investors were reshaping their portfolios. Meanwhile, the private equity world had entered what one analyst called the Great Pivot. PE firms began quietly acquiring distressed import-heavy companies only to restructure their sourcing models domestically and rebrand them as made-in-America darlings. It was ruthless, yes, but also smart. One such story came from Detroit, where a century-old auto parts supplier, once dependent on Chinese steel, was bought out by Titan Ridge Capital. Within 6 months, they had pivoted to recycled domestic steel and signed a new deal with Tesla's U.S. Gigafactory. The company's valuation tripled. It's all about narrative and necessity, said Julian Ong, managing partner at Titan Ridge. You take pain and you turn it into patriotic productivity. That's the playbook. But not every pivot was successful. Some small and mid-sized businesses tried to adapt but couldn't survive the cost burdens. A Kansas-based toy company filed for bankruptcy after failing to find affordable U.S. suppliers for its injection-molded parts. Several restaurant chains that relied on imported spices and specialty foods had to slash menus and close locations. Even some major retailers scaled back product variety due to import restrictions and increased costs. Consumer behavior also began to shift. Americans became more conscious of product origins both out of economic awareness and a subtle revival of patriotic consumerism. Online marketplaces added Made in the USA filters. Local farmers markets saw increased foot traffic. TikTok videos promoting American-made alternatives went viral. Ironically, the shift created new entrepreneurial opportunities. Startups like Forge Local, a platform that connects small businesses with verified US-based suppliers, saw explosive growth. Influencers on platforms like YouTube and X, formerly Twitter, began offering investment advice through a new lens, post-globalization investing. Podcasts like Rewired Capital and The Tariff Diaries rose to the top of the financial charts, blending real-time news with deep investment strategies. They decoded legislation, broke down commodity trends, and interviewed CEOs pivoting under pressure. As one host, Melissa Tran, famously said, "This isn't just about tariffs. It's a tectonic shift in how the American economy defines strength. We're not just investing in companies anymore, we're investing in philosophies." By September, the political temperature hit a boiling point. A bipartisan bill, the Strategic Trade Stabilization Act, was introduced. It aimed to create a flexible tariff framework that could be adjusted quarterly based on inflation, job creation, and global diplomatic feedback. The bill included tax incentives for domestic sourcing and penalties for companies that pivoted production overseas post-subsidy. The market responded favorably. Tech and industrials rose. The dollar stabilized. Treasury yields fell slightly as confidence crept back in. Still, not all investors were convinced. Many hedge funds continued to short global shipping firms and currency-sensitive manufacturers. Meanwhile, others doubled down on U.S. manufacturing REITs and small-cap logistics. As Q3 earnings rolled out, one thing was clear: the rules of the game had changed. Whether the shift was temporary or permanent remained to be seen. But those who moved with clarity, agility, and principle were emerging from the fog stronger than ever. To be continued in Part 5, The New American Portfolio. By the final quarter of 2025, it wasn't just the economy that had shifted, it was the American investment mindset itself. Wall Street's old playbook was under review. Diversification still mattered, yes, but the once sacred 60-40 portfolio split, 60% equities, 40% bonds, no longer inspired confidence in a world dictated by tariff tweets and surprise sanctions. Risk management wasn't just about sectors anymore, it was about strategy in the face of geopolitics, nationalism, and a fragile global system. In the heart of Manhattan, a quiet revolution was underway inside the offices of firms like Fidelity, Charles Schwab, and Morgan Stanley. Advisory teams began offering a new approach to portfolio planning, what they dubbed resilient investing. This model included 4 core pillars. Domestic core holdings, companies that thrived in a post-tariff, America-first economy. These included industrials, U.S.-based logistics, regional banks, agriculture tech, and small-cap manufacturers. Strategic alternatives, investments in non-correlated assets like farmland, private equity, REITs focused on U.S. supply chains, and digital infrastructure platforms building rural broadband. Global opportunity funds, selective exposure to countries with favorable trade terms or manufacturing capacity moving out of China, such as India, Mexico, and Vietnam. Inflation defense mechanisms, a mix of TIPS, Treasury inflation-protected securities, precious metals, and commodity-focused ETFs that could hedge against cost-of-living spikes. Analysts and influencers began branding this as the new American portfolio. It wasn't isolationist, but it was pragmatic. It acknowledged that while globalization was not dead, it was being remixed with a stronger domestic core. For individual investors, this shift manifested in real ways. Jackie Ramirez, a 29-year-old graphic designer from Phoenix, had always invested through a robo-advisor. But after watching her international ETF tank while her friend made gains off a US-only dividend stock portfolio, she made the switch. "I used to just set it and forget it. Now, I read trade headlines before I check my Netflix queue," she laughed in an interview on NPR's Marketplace. Even younger Gen Z investors, once almost entirely focused on crypto and meme stocks, began showing interest in dividend yields, reshoring trends, and energy independence plays. TikTok investing influencers began talking about copper mines, semiconductor fab plants, and rare earth recycling startups. At the national level, the results of the Strategic Trade Stabilization Act began to show. Inflation cooled slightly down to 3.2%. Unemployment held steady at 4.1%. U.S. manufacturing posted its first 3 consecutive months of job growth since 2018. The stock market regained its footing, with the Dow flirting again with all-time highs. President Trump, in a rare fireside-style video address from the White House, declared, "We are rebuilding the American economy from the inside out. The tariffs were just the beginning. What you see now is a rebirth of factories, of pride, and of power." Not everyone agreed with the bravado, but investors could no longer ignore the changing terrain. ESG investing, once the hottest trend in asset management, was now competing with what's dubbed NSG investing, national security and growth. These were portfolios built around defense contracts, secure infrastructure, and cyber sovereignty. Even Silicon Valley started to rebrand itself not just as disruptors, but as protectors of American digital infrastructure. And just when it seemed like a new rhythm had been established, another twist arrived. China announced retaliatory tariffs on rare earth exports to the U.S., sending tech and EV stocks tumbling. In response, the White House fast-tracked a $20 billion initiative to develop rare earth alternatives domestically. Shares in a Colorado-based mineral recycling company doubled overnight. Once again, opportunity and uncertainty walked hand in hand. So, what lessons did American investors take from the tariff saga? Here are the top takeaways echoing across boardrooms, podcasts, and kitchen tables. Volatility is the new normal. In a world where economic policy is as much about ideology as it is about numbers, markets will move faster and more erratically. Geopolitical awareness is now a core investing skill. Understanding diplomacy, defense, and global alliances matters as much as earnings per share. Flexibility beats conviction. Investors who were able to pivot sector to sector, fund to fund, outperformed those who clung to pre-2020 assumptions. Narrative drives returns. In the age of social media, a powerful story of patriotism, self-reliance, innovation can drive capital flow as much as fundamentals. As the year closed out, Americans weren't sure what 2026 would bring. Would tariffs expand? Would a trade deal emerge? Would Europe, dealing with its own political upheavals, drift further from U.S. markets? No one could say for sure. But what was certain, the investment landscape had changed forever. What was once a smooth, interconnected machine was now a churning, recalibrating engine of resilience. And for those paying attention, for the curious, the adaptable, and the daring, there were fortunes to be made. This was the new age of investing. Not built on predictions, but on preparation. Not on fear, but on flexibility. Not on nostalgia for the old world, but on boldness in the face of the new.